and welcome to CAP STRAT This Week. I'm Mike Warford. With me is Mike Rarey. Mike, thanks for having me back again this week.
Oh, glad to have you.
Happy to be here. We've got another 2023 month in the books. We'll be looking at the drivers of August market performance, and then we'll go ahead and get into the framework and talk about what we see coming on the horizon here. Starting with performance, just the three main drivers in August, in our opinion. You had the Treasury quarterly refunding. Biggest impact from that. Looks like we're going to be issuing more debt than previously thought. Certainly talk about the implications of that coming out. Economic data, particularly in July. Data received thus far in August has been particularly hot. Talk about the implications of that and what that may look like for the remainder of the year. And then China, continuing to take measures in an attempt to protect their asset markets, spur economic growth. Seem to be struggling a little bit there, so we'll get into that as well.
Right.
But any details you'd like to cover as far as market performance?
Yeah, those first two things you hit on, the Treasury quarterly refunding, you think about supply and demand for Treasuries going forward. We know demand, there should be less demand. Foreigners aren't buying as much. The Fed's trying to buy less. Right. But now we're going to be getting more supply. Deficits are worse than expected. So there's going to be some issuance coming up, and you combine that with the hot economic data, and what you got, the knee-jerk reaction to that was longer-term bond yields rising. And that's where, in our view, the market dynamics for August, which is this month-to-date column, really kicked off. Once those longer-term bond yields started rising, we saw equities start to decline, having some of their worst declines since last December, which was also a time when bond yields were rising, growth stocks in particular. Right. And, you noted the economic data we were receiving was great, so it wasn't anything related to that. The earnings data wasn't bad at all. Companies were generally beating. So that seems to be the primary reason why we had a sell-off across the equity space. And then in China, you see that down in emerging markets, down over 6% for the month. The MSCI China index down double digits. And we've seen, the currency weakening, just basically China busting out pretty much all the stops in terms of announcing new stimulus measures, reform measures almost daily, sometimes multiple measures per day, but not going all in with the bazooka, the big stimulus plan, the big infrastructure spend like they would have in 2008 or 2015, 16, or even 2020. So, you see that throughout the equity markets, those dynamics you spoke to. You see it in fixed income as well, 30-year Treasury down over 3%. That was a tough month. Got a little bit back here in the last week of the month. And then you also see it flow through to alternatives. So a basket of commodities down 77 basis points, and you look at things like industrial metals, down almost 5% from the month. That's definitely China related, right? Even if economic growth data in the U.S. is better than expected, a lot of that's services. The primary demand for things like industrial metals and commodities and aggregate is coming from China, and that's going to be weaker than folks previously thought.
Yeah, absolutely. You can kind of see that across the board, not just industrial metals, but grains and energy, kind of those harder commodities down significantly year to date and struggling in August as well. Mm-hmm. Let's dive in a little bit further on economic data. We talked about July data coming in hotter than expected. A lot of interest in GDP and economic growth and what that's going to look like. But what's going on the economic growth data front?
And we've spoken this a little bit in previous video shoots. It's so important right now to not take any single data release at face value. The revisions are significant, and you have to corroborate every data point. Right. So we've been talking about this for a while. This is GDI, gross domestic income, versus GDP, gross domestic product. We all watch gross domestic product. We know the Q2 figure got revised down to 2.1%. We got that news last week. That's still pretty good. Year over year, though, real GDP is running at 2.5%. Now, theoretically, gross domestic income is identical to gross domestic product. They measure the same thing, but from a different angle. Right. It's sort of an economic identity that spending equals incomes. So we also show real gross domestic product. We got the first gross domestic income. We got the first Q2 gross domestic income number. Year over year, gross domestic income is actually down 0.5%. And it's been negative on a year over year basis for 3 straight quarters. So telling a totally different story about the economy and the momentum within the economy. So it obviously begs the question, which number is right? How do you think about this data? You know, in our view, best case scenario is the economic data we've seen is somewhere in between these two numbers. You know, if you were to average them, you know, something in the low 1% range, and we would expect that the GDP data, which is more heavily revised, will ultimately get revised down towards GDI. And this is a dynamic that we've seen previously. You know, right now you take the spread, this bottom bar chart shows the difference between GDI and GDP. Right now it's a 3% spread. The last time it was anything near this large was heading into the global financial crisis. And what's important is the GDP figures, the numbers we're showing are the final revised data.
Right.
This gap was even larger if you were actually sitting there in Q4 2007 looking at the unrevised GDP data or the first estimate of GDP data. It was even larger. So that's what we're talking about. This is clearly, you know, there are seasonal adjustment factors here. There's all this stuff, but the idea that the economy has been growing lights out, sort of the no landing scenario, that's not being corroborated by the GDI numbers. The GDI numbers are confirming that, hey, the truth's somewhere in the middle, and the economy is slowing or was slowing through Q2. The Q3 incoming data is a different story though, right? The Q3 incoming data, the Atlanta Fed GDP Now data tracking in the 5s.
Yeah.
Plenty of time for that to come down and subsequently get revised down. And, you know, we'll see what the data for the August month and September month ultimately show.
Yeah, and that's, I mean, really interesting time right now, right? Not only do you have kind of this spread between GDI and GDP, which we would expect to be identical over time, but you also have, just even within GDP, looking at the different areas of Fed forecasts. You mentioned the Atlanta forecast at around 5%, north of 5%, and the St. Louis Fed forecast at negative now for Q3 GDP growth. What kind of implications could all of this uncertainty have for monetary policy, for economic growth?
The biggest concern is that the Fed gets head faked by the data and they make a policy mistake. So the Fed knows about GDI. They're making the nowcasts, right? So they're aware of all of this, but you kind of need to pick a side. And we're at the point where, you know, if the Fed puts too much stock in the GDP data, they might leave rates too high for too long, or have one extra interest rate cut or interest rate hike as an insurance hike because the incoming data is hot. And that could be one too many. So all it does is increase the noise, make it harder to find the signal. And if you're a policymaker, it increases the odds of a policy mistake in either direction. You know, in our view, the data, the truth is the economy is slowing, and it probably supports a pause in September and maybe no more hikes, but it's not weak enough to support cuts.
That relates exactly to what we were talking about last week, where perhaps the probability of that no landing scenario is falling while the potential for a policy error to either side is potentially increasing. Should we get into the framework now? How about
let's do it.
How do these things impact? Let's start with economic growth before getting into inflation and then liquidity.
Yeah, so now showing our forecast, our GDP forecast out the next 4 quarters. You know, we're seeing the Atlanta Fed nowcast for G3 coming in hot. We're revising up our Q3 number within these forecasts, but we're not revising up the Q4, Q1, Q2 of next year. And we've talked about the dynamics there. Excess savings are depleted. You know, it's clear the labor market is slowing. It's clear that the past economic data is probably going to get revised down. So that's the only real update here. But, you know, with it coming in strong, that obviously has the Q3 data coming in hot. That has some knock-on effects on inflation.
Yep. And that seems to be front and center for the Fed these days.
Exactly. So we've talked about this before. If the economic data stays resilient and the labor market stays tight, then there's potential that, you know, something like our forecast plays out, which is headline CPI on a year-over-year basis trends up from here. Which once again could reinforce the Fed keeping rates higher for longer. Certainly does not look like it would be supportive of cuts, rate cuts.
Yep. And so we've got, inflation continuing, potentially, staying flat, potentially getting higher from here based on our forecast. Not much support at all for a Fed cut. How does that start to impact liquidity and eventually corporate borrowing?
Yeah, this really supports the Fed keeping rates elevated, not cutting, and also continuing the balance sheet runoff.
Yeah.
Reducing the size of their balance sheet by about $95 billion a month for at least through our forecast horizon. And so liquidity should stay in a low, very constrained environment. And as we've seen, at some points, this can have a significant impact on asset prices, and other points, not so much.
Yeah.
So that's an interesting dynamic as well.
Yeah, I mean, obviously we had, you see this significant drop off in liquidity change year over year, notable asset repricing in 2022 to the downside, both stocks and bonds. But, ever since we've been sitting down here, markets, especially equity markets, have been just fine, especially domestic equity markets.
Yeah.
Why? Why was this such a big impact, but nothing really happening lately?
Well, the idea is this first initial downturn in liquidity comes from the market thinking or pricing in rapid rate hikes. And when you price in those rapid rate hikes, you're then also pricing in, hey, if the Fed hikes this much and they invert the yield curve this much, at some point, approximately now-ish, that's going to have negative impacts on the economy. You're going to see potentially a recession, right? And that obviously has not transpired yet. And so, we can talk about why that necessarily hasn't happened yet. Probably through the lens of the corporate bond market is probably the best way to think about it. The other way to think about it would be through lens of the housing market, right? Folks took advantage of low interest rates in the years prior to 2022 to refinance their mortgages, and the average mortgage outstanding right now has an interest rate of 3.5%. So the average home buyer is not negatively impacted by current mortgage rates at 7.5%. There's no economic impact of that for them, right? Because folks were able to push out the maturity, financing, and keep a low fixed rate. And that's a little bit of what's also happened in the corporate bond market.
Yeah. So let's compare and contrast that a little bit. Talking consumer and mortgages, no inherent need to refinance the debt or roll over the debt. Americans are able to take out a 30-year mortgage and pay that over time. Corporate debt, a little bit different, first in terms of maturity structure, as we'll see here, and that kind of requirement of rolling over the debt, right, as it comes due.
Yeah. So this data we're showing here, we took all of the investment grade and high yield bonds that are set to mature between 2024 and 2026, and with their current coupon rates, and assumed that all of them, upon maturity, are rolled over the exact same amount, but at current market interest rates. Right? Because we know what's happened. Usually monetary policy would have impacted corporates much quicker than it has this time around, because a lot of companies took advantage of low rates in 2020, 2021, pushed out the maturity of their corporate bonds, and it just hasn't had a negative impact yet. But it's going to start happening, right? So these blue bars are the projected interest expense increase. Every time a bond matures over this time horizon, it's refinanced at current market rates, rolled over. What happens? Well, I mean, you have about a $14 billion increase in interest expense just from the corporate bonds maturing in this window, right? It picks up a lot more as we get out into 2026, 2025. And this puts a lot of CFOs and businesses in decision-making time, right? Everybody knows this is coming, right? CFOs have to do something in advance of this. If your bond's going to mature in December 2026, you're definitely talking about budget impacts when you're planning in 2025, maybe even 2024. What are you going to do? Well, I can either hope that interest rates go down, so when it is time for me to roll that debt, I can do so at a nice rate, and this never materializes, right? You would need bond yields to come down from here. Or you say, I can't bet on that. We may be in a higher for longer type scenario, which is what the picture we're painting with our macro forecast, in which case I need to start cutting spending. I'm going to cut investment spending. I'm going to pause hiring. I'm going to remove job openings. So it's a lot of that as well, right? So these decisions for this upcoming sort of maturity wall, those decisions that impact the economy are probably going to start being made, more frequently, more significantly now. And everybody's just sort of hoping as we get into next year, the Fed can cut.
Yeah.
But, we'll ultimately see how it plays out. And then, we had to scale these numbers. We talk billions and trillions all the time. So, what's 14 billion? Well, as we get out to 2026, that's almost half of the year-over-year increase in business fixed investment. And we've had a strong year-over-year in business fixed investment, right? Strong investment growth. So to think about half of that fixed investment spend is going to be soaked up just through paying higher interest potentially, you can see that's the first order effect of this. The second order is, well, now I need to cut spending in other places, so on and so forth. So
so kind of to summarize all of that, you have this one side of the outcome, which is maybe perhaps viewed as ideal, as the Fed can get to a point where they're cutting rates, and then this chart kind of turns over and becomes much less of an issue.
Yep.
The other side is interest cost continues to increase, eats almost half of our business fixed investment growth from the last year, and CFOs have difficult decisions to make. And I think that ties in well with our recession model. What we've been looking at lately, we've been particularly interested in the labor market. You can see a little bit of sign of red here in that recession signal. We would say the theme in the labor market lately has been, low firing and cool hiring.
Yeah.
And, just recently we saw a somewhat notable tick up in the unemployment rate. Seems like that was primarily from participation, not necessarily job loss. But we could be getting to a point where those CFOs are making difficult decisions and we start to see some more weakness in the labor market. That would be certainly something that would impact our recession signal forecast.
Yeah.
And then, of course, just checking in here, the yield curve signal continues to be active. It's been inverted for quite some time. Hasn't quite had the economic growth and market impact that we would expect it to have, but that's what we were just talking about with all of those dynamics earlier about how that turning point may be coming sometime in the near future.
Right.
So still not active on the recession signal, but closely monitoring those labor market signals.
Yep.
Well, that'll do it for us for this week. Thanks again for joining in CAP STRAT this week. If you have any questions or would like to talk further, please feel free to reach out.